In this week's video, we'll examine the question, are we headed for a pullback, more gains, or the end of the stock rally? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with a few we could be headed for a little bit of a give back period charts. S&P 500 daily as of the close on Friday, October 30th. We all know what once was support may now act as resistance. This was one of the reasons why we decided to be patient with deploying additional capital on Friday. This is potential resistance here, and we would like to see what happens at this line prior to making any other moves. Another area of potential resistance on the daily chart of the Dow, resistance. Now we're back up to the same line. Doesn't mean we can't move to the other side of the line, but it's prudent for us to see what happens here as well. Here's another chart that we were watching near the close on Friday. We have resistance here where the cursor is, resistance, what looks to be a bullish breakout. And then in the last two sessions, we gave it back. So this too is another reason to keep an open mind about the possibility of a pullback here. No predictions, just respecting these trend lines in the short run. Do the previous three charts mean the rally is over and it's all gloom and doom? Well, price will decide that, but not necessarily. On the way up, these three fibs acted as potential resistance. We've broken through them, so it's possible that they will now act as potential support. We also know the bullish ramifications of taking out all three of these fibs. This chart would align with a pullback scenario over pulling back to make new lows from a probability perspective. 2 points here, and then we'll keep moving. Point number one, when we made the new closing high here on Wednesday, RSI also made a new high. That's a good sign looking out for the next few days and weeks. The other point is we have all of these areas that acted as either support or resistance recently, and we've cleared them all. Therefore, if we do get a pullback, all of these levels may act as possible support. The Nasdaq gives the bulls some additional hope. Remember, we opened the video with the three charts that said we may be ready to get a pullback. The Dow hasn't cleared basically this type of trend line. Well, the Nasdaq blew right through it, and it wasn't a problem. It did pause there for a time, and then it blew through it. We showed you the S&P 500 chart that had this angle. Well, the Nasdaq has blown through that one and retested it. Now, that doesn't mean it can't fail, but all of these areas here and these lines here could act as potential support on potential weakness. But right now, this chart still looks pretty good. Another reason to keep an open mind about an ongoing rally and or a relatively shallow pullback over the return to all this talk about a bear market, which can still happen. Still believe the charts are saying that's the lowest probability outcome of the three. The probability is not zero, but given what we know today, it's not particularly high relative to the other two. Why? 200-day, 100-day. We know when moving averages get together and get tight that we can get big moves. So this is obviously a cluster here of moving averages, a lot of resistance. This is that gap that we had, and we talked about it. We'll revisit it a little bit this week. This is a huge gap up. And we've held here, and we've got these moving averages now below that are tight. Doesn't tell us what's going to happen, but this chart still looks pretty good, And the NASDAQ has held this breakout above this line as well. We'll keep an open mind heading into next week. Now we're looking at a NASDAQ weekly. It's acted as support here, support here, support here. We closed above those levels on the weekly chart. We're back above the 50-week moving average, a rising 50-week moving average, all of that good. And momentum on a weekly basis has now moved into overbought territory. And that sounds bad, but as long as you stay in overbought territory, good things can happen. This is the weekly chart of the NYSE composite that we've been using for some time. This too leans toward the either a shallow pullback or ongoing gains probability outcome arena as well. Why? Resistance, resistance, support, support, support. We broke below that key level, and now we're back above it, and we've closed above it for several weeks. It's possible that we get a congregation look for some time, but the longer that we can stay above this level here on a closing basis, the better. We closed above it at 10,461 on Friday, October 30th. Same concepts. We're looking at a monthly chart. What once was resistance may now act as support. We're back above that line, and this look is more relevant now because we've hit the end of the month. It was the last trading day of the month. This will be printed that we closed above all of these levels and all of these levels here. All things being equal, that's where the bulls want to be. The bears want to be on this side of the blue line. On the bullish end of the spectrum, the double bottom worked out pretty well so far. We have not hit either of these targets yet. We also have a bullish breakout here. This acted as support here. They intersect somewhere in the neighborhood of 2065 on the S&P 500. This could act as possible support on any additional pullback. Last week we talked about the runaway gap scenario as being one of many possible outcomes. Here's the gap here. The low of the gap here intraday is 2058. We came back and retested the gap on Tuesday of this week. And on the first pass, it was a successful retest. The low here matched the low here. We did not fill this gap here. As long as this gap holds, it leans bullish. It's very possible that the gap could get filled next week or in several weeks, but right now we're above it, and a lot of these areas here could act as potential support. This is the lower trend channel that we've been looking at for a few weeks. This is another area we could retest this breakout, and that would take us down somewhere in the neighborhood of 2030. We'll add 2 additional pieces of evidence to this list that we've been looking at. This is our stair-step list where the evidence builds over time. October 2nd, we had the bullish key intraday reversal bullet points. The following week, we had the bullish breadth thrust. Most important lows are marked by a sharp surge in breadth. We had it. We covered it on October 9th. Another sequential building block in the bullish case was talking about the fact that overhead supply doesn't necessarily mean it will act as resistance. It may act as possible resistance. And so far in 2015, we've exceeded and held levels similar to the ones we covered on October 9th. Another brick in the bullish wall came and was covered on October 16th in the video in the form of the bullish TDST DeMark breakouts. It's a proprietary indicator from Market Studies, LLC. And last week we talked about the potential for runaway gaps on some of the major indexes. That was covered on October 23rd. We've already shown you in this video that so far these gaps have held, which is a good sign from a bullish perspective. The longer the gaps hold, the more relevant it becomes. Not only did the gaps hold earlier this week in terms of adding another brick to that wall, but the manner in which they held on Wednesday was fairly significant and impressive. On Wednesday, this is a 60-minute chart here where the cursor is. This is October 28th, which is Wednesday, the day of the Fed statement at 2 p.m. If you were watching the markets that day, you know we started to sell off after the Fed announcement. And at 2:29 on that day, we said the market has a reason to sell off hard today, and that we'll learn something either way, if it sells off or it stays firm. Well, it did start to sell off hard here in SPY. This is the low of the session on the 60-minute chart here. And we didn't sell off hard. In fact, we rallied hard into the close, and we were able to hold those gaps with a very, very impressive intra-session reversal late in the day. Can we learn anything else from this session? Yes, this day was incredibly bullish. You can see we ended up over 1% on SPY, occurred on 136 million shares roughly in SPY. Friday's sell-off, lower volume, 120 million shares. Regular viewers and clients know that we're not real excited about yearly analogies, but we are excited about studying past bottoms and rallies. We think that's very, very helpful. So let's look at 2011 and see if we can learn anything about a bottoming process. Here's the low, here's the retest. So this would be similar to October 2nd in 2015. This was the first day here in 2015 that the model started redeploying capital. You can make an argument that in 2015 we might be up in this area here where we may be in a situation where we have some give back. As far as the 2011 analogy goes, be careful what you wish for if you want it to follow the exact same path. In 2011, from this point here, the market fell 10% on a counter trend rally and then rallied hard. Where did we fail and have this big give back, and can we learn anything from it? This is the first angle off the previous high. The red line is the second angle. You can see we failed at the second angle in 2011. In the end, we're going to compare this chart to the present day and see if the present day looks weaker or stronger or similar. I call these back trends. What's a back trend? If you look at the blue line here and the parallel green line here, one is based on closing prices, one is based on high-low close. This is the previous trend that held. This was support, this was support. And often markets rally back to that back trend line and fail, as it did in 2011. This is your overhead supply here. We also rallied right through the first band here of overhead supply. We weren't so fortunate at the second band. What once was support, what once was support, what once was support may now act as resistance. Therefore, in 2011, price failed for the counter trend rally here at three logical levels. The second angle, the second band of possible resistance, or the second band of overhead supply, counter trend rally, and the back trend line, what once was support, may now act as resistance. How are we doing relative to the three same levels in 2015? Here's our probabilistic low that occurred in October, late September. This is the back trend line here. What once was support, may now act as resistance. Remember, in 2011, we reversed hard and had a sharp 10% counter trend rally at this level here. Not so in 2015. We ultimately blew right through this back trend line. In 2011, remember, we showed that the market blew through the first band here, what once was support may now act as resistance. It went through it in 2011, but we said the second level of overhead supply or potential resistance, the second band, did bound price in 2011. Not so in 2015. In fact, we have that impressive reversal on Wednesday on relatively strong volume. We were going to give back these levels here, and we recaptured them, and we still closed above them. That's a good sign. In 2011, the second angle, which is after the highest high, bounded price in 2011. Not so in 2015. Therefore, based on these somewhat arbitrary parameters, and we'll admit that they're somewhat arbitrary, the situation in 2015 appears to be better and stronger and have more conviction than what we saw in 2011. So now, instead of these three areas acting as potential resistance, we've cleared them. Now they may act as potential support. We could pull back all the way to 2030 here, and we would still be above the levels that we broke out. So keep in mind that a move back to 2030 could be in the probabilistic cards. Before we look at this example, it should be noted that the previous analysis of 2011 relative to 2015 is not unique to 2011. That's just simple support and resistance, and those concepts of back trends and trend lines and support and resistance apply to all corrections and subsequent rally attempts from a probability perspective. Point of the exercise here. This is roughly 3 p.m. on Friday, October 30th. This is a weekly chart. We're looking at the 40-week moving average in blue, the 45-week in red, and the 50-week in green. There's nothing potentially magical about them. We're using these purely for illustrative purposes only. The S&P 500 closed above all three of these lines this week. In fact, it closed above them for the second straight week. And notice how tight they are here. In 2011, did we do that on the first pass? No, I went back and looked. This is 1 week above those same levels. Now we're 2 weeks above. What happened when we did close above those levels for 2 weeks? We gained an additional 11.3% from this point here to this point here. Now we're looking at the exact same weekly moving averages. Now we're looking at 1994. One takeaway. Notice on the first downturn in 1994, and when we tried to move above the moving averages, notice how long the market had been frustrating and trendless. How do I know that? Look at the slopes of the moving averages here. They're flat. That's not what we have today. They're flat now. But these moving averages on this rally attempt had literally been flat for months or weeks here. We're really just starting to flatten out now. One takeaway here, during the frustrating periods, it's difficult. But if you stick to your discipline. Typically, when you move sideways, you either get a big move up or a big move down. In this case, the discipline was rewarded with a big move in the S&P 500, and we followed a trendless period with a wonderful and relatively easy period for trend followers. Again, we're not big fans of the yearly analogies, but we are fans of studying bottoms and subsequent rallies. We understand that 1998 is a different period than 2015. That argument applies to every single historical reference in the history of mankind about the markets and the economy. There are no two identical periods in human history. What can we learn potentially from 1998? Notice we came down and we had our double bottom. In this case, prior to the correction, we could see white space between these moving averages. The white space told us that unlike the malaise in 1994, where they went sideways and we could barely differentiate between them because they were on top of each other, this is a relatively strong trend, a correction, and a continuation of the trend. 1994 was a trendless and difficult market. White space, here, when we came into this, white space, white space, white space. In this case, we rallied for a time and never really had a significant retest after the double bottom. We went up and never came back down. This is not a forecast about what will happen in the present day. It's simply an observation that says the trends prior to this correction were stronger in the year 2015 than they were in 1994. This looks more similar to this period here than the period we just went over in 1994. All of this helps us keep an open mind about all outcomes, including better than expected outcomes, which is what happened in calendar year 1998. We opened the video with 3 charts that told us to be open to a pullback of some kind. This chart goes the other way. This is our lower trend channel. We're still in this upper trend channel, and there is potential support below. Here we went from the lower bound to the upper bound, the lower bound to the upper bound. If we went from the lower bound to the upper bound, we would exceed 2130 on the S&P 500 index. This is a breakout here. Nothing says a retest might not be in order. One of the great things about the market model is we use consistent inputs to make decisions rather than getting overwhelmed with numerous and countless inputs, and some of the inputs are not particularly helpful even when we think they're helpful. This is our full bore bearish look. This is our full bore bullish look. As of the close on October 30th, we still had a favorable look from a probability perspective. Regular viewers and clients know that when we get these tight looks, we can sometimes get a big move. We're starting to get a tight look here. If I look at these charts only with a biased and bullish mind, I might miss something that's right in front of us now. In this bearish example, we have a tight look here and a big move to the downside. But notice, we have a counter trend rally here as well. The counter trend rally is up. We went back up toward tightening moving averages like this and actually exceeded those moving averages before price decided to go in this direction. We have something similar here. We were above the moving averages. We went back to the tightening moving averages and actually closed below it on a weekly basis. And then price decided that it wanted the tight look to be resolved in a bullish manner. Nothing says we can't have something similar here. These charts tell us to keep an open mind about a big move. They also tell us to keep an open mind about a retrace down into this area here. Unquestionably, like the prior charts, this is an improving look. It still has some work to do. How does it do that work? Sometimes it requires time for these moving averages to catch up with the faster parts of the model. It might be a counter trend rally. It might be a counter trend rally. If we do, we would come down in this area here, and then what would we do? Price, charts, and the hard data would be our guide. We'll close with this weekly S&P 500 chart, and this one is as of the close, not 3 p.m. on Friday, October 30th. This chart helps us with both themes. What once was support, what once was weekly support, may now act as weekly resistance. So this area here is aligning with the theory that we should keep an open mind about the possibility of a counter trend rally moving in this direction. This was one of the charts that told us we want to see what happens here before we consider redeploying additional capital into equities. That's the be open to a pullback case. This works on the other end of the spectrum. Remember, we showed that in 2007, 2008, when we moved back up, we only closed above the 100-week moving average for 1 week. We have now closed above an upward sloping 100-week moving average for several weeks. So everything that we have in front of us now seems to point to the scenarios in this order. And this isn't an opinion. This is a probabilistic look at the charts that we have. The bullish case for higher highs still seems to be a higher probability outcome than making lower lows. The emphasis is on probability. It doesn't mean we can't make lower lows. And our forecast is subject to change if the inputs change. Another scenario that has weight and also is a higher probabilistic outcome given what we know today than lower lows is the potential for a counter trend rally in this direction. 2 out of the 3 scenarios described there ultimately lead to higher highs. We're open to adjusting those probabilities when the data changes. That assessment is based on the facts that we have in front of us today. It's been a frustrating period. We can't control what the market does. 1994, frustrating. If you broke your discipline, you missed that massive move. Our job here, we can't control the market, but we can control our attitude and we can control how we execute. The key to success here is consistent execution over time, and eventually the market will trend in one direction or another. As always, we'll head into next week with the attitude that the market model, the charts, the moving averages, and the risk-on, risk-off ratios will guide us if we're willing to listen with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.